Okay, good morning, everybody. Good afternoon for those of you coming from the East Coast or from abroad. This is Kurt Frankenberg. I'm the founder of RadioActive Trading, author of the Blueprint, and all-around handsome fella, right, Mike?
Sure, we'll go with that.
Hey, I'm not showing my face, so I can get by.
That's right.
I'm joined, of course, by my good friend Mike Chepka, and Mike Chepka is on the East Coast. And how's the weather there, Mike? It's a bit chilly here.
Yes, chilly and snowy there, I've heard. I don't know if you got the snow yet or if it's coming. And
we
then,
did.
Oh, you did? Okay, so we're getting the remnants of that, but it's warm enough here just to be cold and drizzly, a good October day heading towards Halloween, of course. So nice and dreary and a little damp and the kind of weather you want.
Got it. Well, cool. Well, hey, today I had mentioned, or actually on Tuesday I had mentioned that I was going to show different adjustments, and we're going to show a different adjustment than we did on Tuesday. The first part of our presentation is going to be very close to the same, and then the last part will be fresh, I think, for a lot of folks. Now, of course, if you've been following the radioactive trading methodology for a while, you're going to find that, geez, we keep repeating some of the same income methods, and there's a reason for that. It's because there's 10 of them, and we want you to pick up the blueprint, if you want to get all 10. But we will be showing today. I'll be showing income method number 6. Let's see. I'd like to do a poll here and see, do a little bit of an introduction. I'd like to know what kinds of options trading our audience is doing now, and we got a small crowd today, and I think that's good. I think that's good. Very often we have scores of people, hundreds of people sometimes, but today we just got a couple dozen, and that's good. A more intimate group, more intimate setting, and if I know some things about you from these polls, it's going to help Mike and me to make this very detailed just for you. Okay. We get a pretty savvy group. A lot of folks doing spread trades, and same as on Tuesday, we've got more folks doing long calls and puts than anything else. It's really interesting, isn't it?
Oh, absolutely. Usually we see more covered calls, or I think the last time we had more covered calls, and then we saw more spread traders. This is a little bit different.
Yeah, absolutely. Okay, let me go ahead and leave this up for another 3 seconds. That'll be a full minute that we have that poll up, and stop it. Okay, and it ended up being a tie between long calls and puts and spread traders. Yeah, for a little while we had the long calls and puts. You guys were ahead of the spread traders. Well, very good. Okay, cool. And 67%, about 2/3, are still doing the gateway drug, covered calls. So, all right, very nice. Let's see. I'm going to ask if. Well, you know what? We'll get to that poll question here in just a minute. Let's do just a quick introduction, very quick introduction. My name is Kurt Frankenberg. I've been teaching about options trading since 2002 on my blog and on my my website called RadioActiveTrading.com, and it's undergone a few changes and iterations since 2002. But been in continuous operation, and along the way I met this good fella Mike Chepka. Mike is the Director of Options Education over at Power Options, and Power Options is the tool that I use to find the best candidates for trading my unique way. And I've actually used a number of services. It was my good fortune to begin using Power Options about 4 years ago. About 3.5 years ago, I had a private coaching session with you, Mike, and in a minute maybe we'll talk about that. But that was the beginning of a friendship between our companies and between people in both camps, and it's really grown quite a bit, and I couldn't be more pleased. If you are not looking to trade the way that I do with married puts, but you do options trading, you need to look into Power Options. Power Options is the top platform for searching for what is it now, 23 different strategies that
Yeah.
that y'all support?
Oh, yeah, over 23 different strategies, about 24 different strategies, and we're looking to expand some into the future as well. So yeah, we support patented search screens, analysis tools, research tools, and tracking tools, the portfolio tools, for not only finding, comparing, and analyzing positions in those 23 different strategies, 24 different strategies, but also in the portfolio tools you're tracking positions, you can evaluate potential rollout opportunities where all the math is done for you, and you can evaluate side by side to see which one matches your criteria, your expectations. Yeah.
And something that I really appreciate about Power Options. Sorry guys, I'm just doing a brief commercial here for Power Options because I believe in it. But one of the things that I appreciate is that the custom spread tool. You see, today we're going to be taking two strategies, Mary Put, and also combining it with spread trade or two. and we're going to be looking at what that does. You know, when you combine one strategy with another, it actually can subtract risk from both.
Yes.
And that's really interesting. So, and Power Options is the only company I'm aware of that will support, and not only support but also even suggest. You know, hey, have you looked at doing this? You know, if you have a Mary Put position that's up, it might suggest to you, hey, you know. Kurt Frankenberg teaches these income method adjustments. Would you think about doing this or this or this, and make those available right there? So anyway, sorry to ramble there, Mike, but I want to introduce you a little bit. Is that okay?
Yeah, that's fine.
Okay, cool. Mike's been working for Power Options for I think 9 years now.
That's right. Started about the same time you did, actually. Around,
Is that right?
2002 would be about 9 years now coming up. So that's when I started working with Power Options, 2001, 2002. And I was, yeah, go ahead. I'm sorry. I was
going to say I got started trading in '98, but I got hurt, as you know.
Yes.
I got hurt pretty badly, just following the advice of my options trading guru, and then ended up learning what I'm going to call the holy grail of trading. By observing the lives of great traders, I found that they traded different instruments, right? They traded different types of systems, different timing, different hold times, and just completely differed in almost every way except for one. And that one thing I decided to harness. And so I'm going to call that the holy grail of trading, and we apply it in radioactive trading. It's not the only way to apply it, but we do apply it. Okay, I think we should go over what's going to happen in the webinar. Okay. And then we'll dive in with both feet. Okay. In this webinar, I'm going to make you 3 bold promises. Here's the first one. I'm going to show you the solution to the biggest problem facing traders today. That's a bold promise.
That's bold, yeah.
In fact, I'm willing to bet that you'll take a look back in your last 12 months trading and wish that you had done that sooner. And in order to, validate that, let's take a baseline reading right now. This is a follow-on poll to the first poll. The first poll said, what kinds of options plays are you doing now? And then now, I'm asking, so how's that working out for you? And I don't want you to, just, oh gosh, I got out of the seminar last week and then I put on my first play and it was a winner. Hey, there's a 50-50 chance of that happening. Right? But I'm talking about consistency. If it's been 12 months or more since you learned the strategy that you're using now, whether it was from a seminar or book or you've got a friend that's tutoring you, or you're just self-taught, okay? If you've been doing it 12 months or more, tell me how you're doing so far. Are you doing great? Are you doing, well, you're ahead, but you're disappointed with the gains that you're having? Or if you're doing not great or not even good? So that's, that's 3 different options. Pardon the pun. Mike, I don't see anybody in the great section yet. That's kind of distressing to me.
Yeah, it's not what we were promised, was it, Kurt?
That's right. I got told that I'd make 3 to 6% per month returns. And that's of course what in trading that way, trading the way that the guru told me, that's what made me go broke.
Right.
Okay. All right, Mike, I've had it up there long enough, and we have had some other folks come in and say that they're doing well. So let me go ahead and share the results. Okay, 13% say great. Okay, that's a happy thing. I'm glad for that. 13%, 12 months of gains, only came today out of curiosity. Awesome. Good for you. Okay, now what about the other 87%? Looks like 88%. I guess it's because of rounding.
Mm-hmm.
Looks like it adds to 101% there. 50% say not great, but they are ahead. And I'm thankful for this, Mike. I'm thankful that nobody in that category there lost money. So about half of our audience is disappointed, but they're also not hurting, and that's great.
Right. That's okay. Well, no, it's not okay, but it's better than losing.
It's better. Yeah, it's better than a sharp stick in the eye. I mean, you know, it's better than the other 38% who have actually lost money overall. And so I'd like to really see what we can do to correct that. We're going to do this poll later on today, okay, and we're going to find out if, in hindsight, after looking at what I have to show, okay, we're going to see if indeed folks that answered this poll, if they would want to go back in time and change what they were doing. Okay, I'm willing to bet that folks are going to want to take a look back and wish that they had done it sooner. Okay. All right. So the second thing is I'm going to show you a riskless spread trade, which is done at a credit. Okay, and normally, oh, you know what? I'm not going to show this one. I'm not going to show the one that would normally involve infinite risk. I'm going to show one that normally involves about a 5-to-1 risk.
Yeah, 5-to-1 or 10-to-1 risk normally if entered just as a straight options play, but in the context of how we play it, it won't add risk.
Yeah, it adds no risk at all. Okay, and our spread traders would be happy to hear this. Okay, and all right, I'm going to show one of several techniques I use to take a credit while leaving the upside potential of a stock completely open. We're going to take a credit, but we're going to leave the upside completely open. That's a little different, Mike, isn't it, than doing a covered call?
Mm-hmm.
If we do a covered call, of course, we end up getting hurt.
We cap the gain,
so,
yeah.
Yeah, I shouldn't say getting hurt. We cap our gain, okay, but if the stock goes way, way up, you feel kind of like a chump. You know, if you take your 5-6% gain and the stock doubles, you left 94% on the table. You know, so that's kind of not the best. Okay, I'm going to point out what the difference is knowing these two techniques, and I will have given you these strategies at no charge. Okay, so let's dive in. Again, we're going to solve the biggest problem once for all. We're going to show a riskless spread trade that captures premium, and we're going to show how to take a credit without limiting your upside. Okay. We've already done this baseline reading. How happy are you with your trading results? Let me just flash it up on the screen again. Okay. 13% were happy. Let me just say that the rest were varying degrees of not happy. Would that be fair to say, Mike?
Oh yeah, I mean it's not great ahead but disappointed with last year's gains. That's essentially not happy.
Right. Okay. So we got varying degrees of not happy. We got 13% that are happy.
Mm-hmm.
Okay. What do you think the biggest problem is? Okay. What do you think the problem is? What does your guru say? Would he or she say, well, okay, it's because you're doing it wrong. Plus, you're in trouble for asking. Believe it or not, I actually had somebody tell me that this one fellow, if you're in his seminar and things aren't working out for you and you ask a question, he'll just shut you down, and yell at you. I thought, wow,
right.
How about that? That's kind of interesting. Is it? Do they blame it on your psychology? Do you say, hey, you need to fix your personal issues? The strategy works, but somehow or other, you're still a loser, right? Or are they encouraging? Do they blow a lot of sunshine at you? Hey, keep working at it. You're almost there. You're going to do it. Or do they upsell? They say, well, okay, well, what you really need, you spent the $3,000 for this seminar, but what you really need is the $5,000 seminar. That is what would do it for you. Okay, and then finally, or is there just no support at all? Okay, so that poll's been up there for almost a minute. Let me find the button here. Okay, and close and share. And of course, it was possible to answer more than one on this, so this adds up to more than 100%. Okay, but about a third of the audience that answers said that their guru is going to tell them that they're doing it wrong. 17% need to fix yourself. Okay, 33% keep. Hey, keep working at it. You know, Mike, what's the definition of insanity? I think this is attributed to Albert Einstein, but I'm not sure.
I think so. It's you know, doing the same thing consistently over and over again and expecting a different result. I get up in the morning, I drink a coffee, I drive to work, I go home, watch hockey, get up the next morning and do the same thing. If I keep doing that 565 days in a row and I keep wondering, well, why is nothing getting better in my life? Well, why should I expect anything to get better in my life?
That's right. Okay, so keep working at it. I don't know how valid that is. 17%, you need the, you know, the upgrade. You need another seminar, and 33% no support at all. Wow. Okay. Well, I am going to say that probably none of those things would be the solution. I think that taking it upon yourself and say, man, it's all my fault, I don't think that's correct. I also don't think it's correct to abscond, or abscond's not the right word, to avoid all responsibility either. I think that personally we got to take responsibility. Okay?
And I get extremely frustrated. I'm kind of offended with the to hear that there are 33% of our attendees answer that there's no support at all. I mean, that personally offends me with some of these techniques because, you know, we do ourselves. We spend a whole amount of our time being supportive, and we try to answer every email that comes in, and we have the free coaching sessions, and we have the toll-free line, and we go out of our way to make sure that our investors understand what they're doing and the principles and how to use the tools. And just to see that there are some people out there who are touting a $3,000 method, promising you these returns and giving you no support after you do it, that kind of offends me, personally.
Yeah. Yeah, you know, yeah, it is offensive. It's like, hey, let me sell you this bucket of sunshine, and then as soon as you have had your appetite whet and you need a little bit more, they're nowhere to be found. They've got your money. So yeah, I've always believed in going the other way, Mike. I've always believed in giving value away for free. And then if folks want more, then I can charge for it. And then if I do charge for it, I'm going to support that forever. And guess what? We get a lot of referrals.
That's right.
We get a lot of referrals and exposure and positive exposure. So that's a good thing. Okay, folks, everybody's heard this little chestnut, okay? They've heard cut your losers short, right? And let your winners run. And that is one of those sayings that kind of goes along the same lines as buy low, sell high.
Yes.
It's like, yeah, I'll do that. When I first heard that, my dad said it to me when I was a kid. You know, he says, son, I know how to make a lot of money in the stock market. You know, we're learning about the stock market in school. And I said, wow, how do you do it, Dad? And he says, buy low, sell high. And at the time, I didn't realize he was just being ironic. I didn't realize he was teasing with me. I thought that, wow, my dad knows a cool secret, you know. And after that, you know, when I for real got involved in stock investing, I found out that low is a relative term. You know? You buy low, it may not be, you know, that may not be low. It may it may want to go lower. All right. And then as far as selling high, you know, whoever knows when that is. All right, but cut your losers short, let your runners run. That's a little more definitive, but it's still not practical. It's still, you know, it's not a full guideline, is it? It's not.
Right.
It gives you the what to do, but it doesn't give you the how to do it. Okay. All right. But Mike, let's take a look at something that I believe is the exact opposite. If we do the covered call trading strategy, are we cutting our losers short and letting our winners run? By the structure of it, by the way that trade is structured, just looking at it.
No, it doesn't really solve what we're trying to accomplish, Kurt, does it? This is more along the lines of cutting our winners short and allowing our losers to run.
Right. It's an algorithm, really. It's a structure that sorts the winning trades out of your account, but then leaves the stocks that don't have the steam, leaves them in your account. And I know what the conventional wisdom is, well, you know, just keep holding on. You know, it's not lost until you sell. Golly, you know, there's a company called Overstock.com that one of the covered call trading gurus recommended. After it went down 67%, one of my guys, one of our converts, one of the fellows that came over to Radioactive Trading from another deal, he said, you know what? What convinced me to trade radioactively is that I was using the blankety blank method for my grandma's account. You know, he was trading his 87-year-old grandmother's account and helping her, you know, with this and having to answer tough questions. The tough question is, when my stock is down 67%, how is it that I'm making 3% a month? What's going on? All right, so yeah, holding on to your losers, that's one thing. What about the winners, Mike?
Well, the winners, hey, it's great. You know, the stock went up as you anticipated. You made the 3 or 4% that you were hoping to achieve. But the stock might have gone up 10, 12, 15, maybe even 20%. So did you realize any of that any of that gain? Did you realize any of that upside holding the covered call position?
Right. Mike, one of your trades last year turned around and yielded you 59.8% gain. Would you have been able to do that by selling covered calls against Silver Wheaton?
I actually tested it. I forget the number, but I wouldn't have made nearly as much because every time I had to roll the call, or if I'd let it get assigned and bought back into the stock as it moved up, it would have cut those gains about in half. It still would have been a profitable position, but I would have cut those gains in half.
Yeah. So no.
Right. Okay. No.
You wouldn't have been able to allow your winners to run. What about spread trades? Do they practice at least half of that maxim? Do they cut losers short?
Well, yeah. What we're looking at here is actually one of the vertical spread trades: bear calls, bull put credit spreads, bull call debit spreads, and bear put debit spreads. Now, as you can see in this position of a bear call spread, this does limit your loss on the upside. You know going into the position exactly how much you're going to lose. So you have cut your losers short, but there's a caveat to that, isn't there, Kurt?
Right. As far as letting your winners run, that's not going to fly. You see, the bear call spread here has a bearish expectation. Say you're selling the 50s and buying the 55s. Well, you collect a credit, and if you're right and your stock goes to 48, you make money.
Yes.
But if you're really, really right and your stock goes to $2, you don't make any more money.
You make the same amount you would have if the stock was trading at 49 or 48 or 47.
Right.
And
Mike, there's...
Oh, go ahead.
I don't mean to interrupt. There's a bit of a popping sound on the line. Do you hear that?
No, I'm actually not catching it. I'm sorry. Does anyone else hear it? It's not coming through to me very well. I'm not hearing a popping sound.
Okay, I'll just kind of try and grit my teeth and ignore that.
I don't know what that is. Yeah.
Yeah. But point is that this doesn't practice the whole saying, does it? It maybe it does cut losers short, but it won't allow winners to run.
And the other thing is that we talked about earlier, is Kurt had mentioned, well, if I sold a 50 call and bought a 55, well, if I'm setting up a bear call spread in that fashion, I'm probably looking at a stock that's trading at 45. I want that short call to be at least 10% out of the money to have a higher probability of expiring worthless. So that means the premium I receive for selling the 50 call and buying the 55 might only be 50 cents. So I'm making 50 cents on this out-of-the-money spread, but I'm risking 5 points. So it's a sort of a 9-to-1 or 10-to-1 risk-reward ratio. And that's important because maybe you did cut your losers short, but if you suffer the max loss on one of those out-of-the-money high probability spreads, that might wipe out 10 previous gains.
That's right. It may just take one loss, you know, to wipe out 4, 5, 10 gains, you know, just depending on how big of a leverage that you're doing. Well, Mike, I got this crazy idea that maybe limiting my downside while leaving the upside open was a better way to go. And I've been proven to be right. Gosh, over the last 9 years, have been showing folks how you can actually be wrong more often than right and still make money. And you know, this has the same outlook, the same market outlook as a covered call. When you buy stock, whether you buy stock or whether you buy stock and hedge it a little bit with a short call, you have a bullish expectation. Otherwise, you don't buy stock. That's just makes sense. this isn't my propaganda. This is copied right out of Option Express's site, and you'll see this everywhere. Okay, you've got a bullish market outlook. Some folks will say, well, no, it's neutral, or it's slightly bearish, and I'm thinking, well, if you're slightly bearish, why do you buy the stock? That's kind of silly, right? I mean, right? Okay, but the thing is, it's widely understood and recognized that it's a bullish strategy. Okay, it's also widely touted as being safer, but I'm going to say that it's not the safest thing out there. Now, Mike, you're the options education director over at Power Options. Would you say that I'm right in saying that covered calls are not the most safe way to go?
Oh, absolutely. Absolutely. If I am entering in a covered call position, the propaganda, for lack of a better term, that we're referring to, the brokers, the brokers claim that covered calls is a safer position, that it's near this bottom bar of being a safer position. Well, a covered call is maybe slightly safer than owning the stock outright. It's slightly safer than buying and holding because you're collecting a little bit of premium, but you're still risking 97 to 95% of what you invested in the stock. If you pick the wrong stock and it does collapse, or it does go bankrupt, or it goes completely opposite of what you expected, you're still on the hook. And I had a conversation with a customer earlier who was considering picking up the blueprint. I believe he is going to pick up the blueprint soon. It was during a coaching session. And he wanted to start talking about the married puts because he had positions where he had gains in them, and he had set stop losses. He had gains in the positions, and he had set stop losses, figuring, okay, this will bulletproof my position because if the stock falls, I'll get out at this price, which is above my cost basis. But the stock gapped down, and he actually got filled for a loss on those positions that he thought he had a guaranteed gain in by using a stop order. And so that's why he's seeing the light now, and he's going to convert to the married put trading to lock in those profits.
You know what? I'd like to talk to that customer if he'd be open to it. I really would, to talk to him about what his experience was, because I've had that experience too. But for me to say it is one thing, for someone in the general public to say, yeah, I got hurt too. Stop orders do not do the trick. A protective put option, that's a legal and binding contract. All right, but a stop order, there's no guarantees there at all. Okay,
right.
So, all right, Mike, I'm going to take a second right here, and I'm going to say that I've got the solution to the biggest problem most people have with their trading, and we're going to show it, and then we're going to ask a question, and the question is, was it right? All right, so, okay, so I've played this particular stock twice in the last 12 months. This is what I talked about in the email. I've played it twice in the last 12 months. Now, Mike, the way that I do this, and when you first saw this, you thought, well, that's a little backwards. It's not the way a married put is normally done, okay? And you also had a bit of a concern with how much I was spending on the put. But here's the deal. It was September 14th, 2010, the first time I played Altera. And I picked up shares at $27.35, and I also picked up a March 6 months away, or 7. Let me see. October, November, December, February, March. 6 months. Okay, it's 6 months out from then, and a $29 put option, so it's in the money. It's above the price that the stock is currently trading. Okay, and you looked at that and you said what?
Well, I understand that you're trying to limit your risk there, Kurt, but at the same time, you've got a stock trading at $27.35, and you've invested $30.85 total into this position. I don't see how you're going to make a dime until the stock goes up to $30.95. And if, by the way, if that's what you're expecting, there might be other strategies you might want to use to take advantage of that.
That's right. See, Mike's paraphrasing a conversation that we actually had 3.5 years ago. And, when he looked at this one, I'm sure that by then, Mike, you knew differently, didn't you? But back then, the conventional wisdom was, hey, you buy a put just for insurance purposes only. You don't buy it for any other reason. And the fact is, you can actually use this put. 3 actually of the income methods detailed in the blueprint involve manipulating the put, taking the put and using it to pay you. And that's kind of cool, all right? But we're not going to focus on that today. I'm just going to talk about now what this looks like. It looks like I've got to make, if I'm going to make 10 cents, the stock has to move up $3.60.
Yeah.
Right?
Mm-hmm.
All right, so that's what the thought is, but that's not really how it works. But just for now, let's just talk about the worst case scenario. Okay, the March put is a $29 put, so I'm guaranteed an exit at $29.
Yes.
Not a stop loss order. You understand? This is a legal and binding contract that I've got for 6 months of time. Now the total amount at risk then is the difference between the total invested and what I'm guaranteed to be able to get back if I wanna at any time. Okay, so $1.85 is what's at risk, or 6%. That's 6% of 30.85.
Yeah.
Okay? Now, here's the deal. I know there's the objection. The objection is, what? You're spending too much. You can't make a dime until Altera makes it from 27.35 to 30.95, because the puts price comes down at the same time as the stock's price goes up. And the thing is, yeah, it does, but not dollar for dollar. And there's some cool adjustments that I can do. In fact, would you be surprised to know that by using the income methods, which were riskless adjustments, these were spread trades that adjust the net position but carry zero risk. By using these income methods, I had locked in a profit by the time that Altera had only gotten to 29.40. What that means is once it got to 29.40, not 30.95, but 29.40, I made it so it was impossible to go back. It was impossible not to make 75 cents a share. And in fact, what happened was the upside was still unlimited, and because the upside was still unlimited, I ended up making $3.85 a share. Right after an earnings announcement. So kind of cool. So what does that do to the 30.85 break-even theory?
Well, it makes me look silly, doesn't
it? It makes the 3.5 year ago you look silly. Yeah, Mike, you know, just a lot of folks have never seen that idea, that you could buy an in-the-money and out-in-time put, and what is possible when you do that. And most folks would never consider doing that because they don't understand what is going to be possible afterwards. Okay.
Yes.
But let me just ask a question. Okay. The question is, if every win that you had last year, you're able to keep, the losses themselves were cut down to 6% or less. You never had a loss of over 6% of the capital that you had in one trade. And if you're diversified enough that 6% actually only represented 1% of your overall portfolio, well then, if you could go back in time, would you? You know? Would you have said I had a great year? Or would you have said, man, I still was disappointed, or I had said disappointed, but I would have had a better year? You know? Or can you honestly say, man, you know what, I did this. I did keep all of my losses down to 6% or less, but I still didn't do well. Okay, let's go ahead and leave that up for about another 5 seconds. And it sounds like you're furiously typing, Mike. If there's some questions that come up that we want to handle, can we handle them right after the right after the mid portion of the presentation?
Yeah, some of the basic, right now we haven't gotten any questions related directly to the techniques. We had Michael commenting on that he stopped by just to see what was going on because he does kind of scalping on the S&P, but he's already joined the webinars once and attended and used one of the techniques there to help with what he's doing. And we had Jamie comment, of course, I believe James commented on that the sound was fine when we were talking about that popping sound earlier.
Good.
Commented on that. So that's about it so far. I haven't had anything else come in yet.
Good to know. Okay, it's probably something I need to do about my own earphones. I need a new set of equipment here. So, okay, so let's see. Mike, I'm going to first address the less than 1 out of 10 that said, wow, you know, I never had a loss over 6%, but I still lost overall. Mike, what are these guys failing to do? And you know, listen, failure is an event, okay? It's not a person. It's an event.
It's a lesson.
Okay? It's a lesson, yeah. You know, you can lose, but don't lose the lesson. So what are these guys failing to do?
Well, they're cutting their losers short. You know, they're keeping their losses to less than 6% on those positions. But they're probably cutting their winners short as well. They may be over trading. They may be seeing a 1% gain or a 0.5% gain or a 2% gain, maybe a 1% gain in 5 days to take that off the table and move into the next position. So they're not allowing their winners to run.
Right. I've got a bulletproof position, and earnings comes out after the bell today. Okay?
Today, okay.
Yeah, that's a position in Deckers, and so it's bulletproof. Bulletproof means that I've used the income methods to reduce the cost basis on the stock and the put to less than what the put strike price is. Can you imagine? So, for example, if I'm holding a $100 put option and I'm also holding stock, and the net cost for both the stock and the put is $99, well, that would be bulletproof, right?
That's right.
Right. Okay. Well, I've got a position like that right now in DEC. So here's the deal. We're controlling the losses, but the upside, man, it's possible. Not only possible, it's probable I'm going to capture some extra dollars when the stock has its earnings announcement. Now, I don't know that for sure. Okay, but it's a really great way to be. Here's the deal. Okay. If you never have loss over 6%, you've got to do the other side too, and not sell at 6%. You've got to try and, leave your upside open. And so that's the idea. But Mike, let's talk about the other 90% or 91%. 45% would have said they had a great year. What was the percentage before that said they had a great year?
That was 13%, Kurt.
Right, and we had 50% say that they were disappointed. Now we've got 45% saying, I had so disappointed, but would have done much better. So that's pretty cool. Okay, I like it. I like it a lot. We're going to talk about dollar amounts later on. This particular trade that I'm showing here went on to make 12%. And after commissions and so forth were counted, it's actually 11.9%. But point is, I never had it risk more than 6% and then made 12. All right, so risking nickels and making dimes, that's the way to go. Okay, keeping your, cutting your losers short and letting your winners run. Okay, so before going on to the income methods, let's begin with that claim that I had of having solved the biggest problem any trader faces. We're going to compare owning 3 positions. Okay, the straight stock, the covered call, and the married put. Now, Mike, we've got the same expectation for each 3 of these. Is it bearish or bullish?
We're bullish. We're bullish. If we own straight stock, we want the stock to go up. We looked earlier at the covered call. Yeah, it's a bullish strategy. We do agree with that. We want the stock to move up to get our maximum return. And we saw the married put graph as well. That is a bullish strategy. We're expecting the stock to increase in price.
Right. Now, I am going to move on beyond this. We are going to share the riskless spread, or one of the riskless spread trades from the blueprint, okay? But let's first look at just a comparison between these 3 beginning positions, okay? If your stock goes up 20%, out of the 3, who wins the biggest?
Oh, the stock owner. Doesn't have a capped gain, didn't have any hedge. He makes 20% on that position.
That's right. He did not have a hedge. He did not cap his gain, and he also didn't burden himself with the cost of insurance. So he makes the most. He makes 20% gain. Now, the covered caller, is he going to do better or worse? Well, obviously.
He's going to do good. He's just going to do worse.
Yeah, he's doing well, but he's satisfied with a smaller gain. He's in and out, and that's all good. Okay? And now the married put is going to yield less. And how come it's going to yield less than just the straight stock?
Well, the put is a hedge. We paid a little bit more cost basis into the put. The put's not going to lose 1-to-1 with the stock. So if the stock goes up 20%, we're not going to be at break even because of the put. We're still gaining positive delta, but we're not going to gain the full 20% on that position. Okay.
Now, the example that I'm using here is very similar because I just showed Altera, where Altera gained 12%, right? Okay, so yeah, and the stock actually didn't have to go up 20% for that to happen. It only went up 17.3% for me to make the 12, but I digress. Here we are with winning 3 different ways, okay? All right, so let's take our winnings and we'll put them into a new play. Okay, take our winnings, put them in a new play, but this time the stock goes down 20%. Now, who's the biggest loser out of this?
Well, the stock owner, unfortunately. They didn't have any premium collected from the call, and they didn't have the protection in place. So they're going to lose 20% on their second play.
Yeah, no hedge. They had no hedge, and so therefore when the stock goes down, they lose the biggest. Okay, so what about the covered call player? I'm going to be real generous and say that he got a 5% premium, which you can't always get, but if you did, then what?
Well, the stock drops 20%. We keep the 5% premium. Call expires worthless. We're holding a position that has a 15% loss, or it's down 15%.
That's right. Okay. And then finally, the married put guy, the guy with the married put, he set it up the way that I just showed Altera with a maximum 6% loss. So if it's down 20%, I'm going to assume that he doesn't want to wait and see if the stock recovers. He's just going to get out. So all three of these get out at the same time. They get in at the same time. They get out at the same time. We've got different types of losses. Now, let's do the comparison of their results, okay? Because both of these guys have a trading record where they were right on a stock once and they were wrong on a stock once. So 50% winners, right? Not 50% win,
right.
but 50% of the time they're picking a winner. Okay, so the straight stock makes 20%, then loses 20%. He's about where he started, right?
Well, that's not the way that math works. We'd like to think that, but that's not how it happens, is it, Kurt?
No, and here's why. Okay, it's logarithmic. It's not arithmetical. It's logarithmical. Something like that. Here's the deal: you have a net loss. Whether you make 20% first and then lose it, or lose 20% first and then make it, the 20% is based on what you got. Okay, so if you start with 10,000, you make 20. There's 12,000. So you take your 12,000, you wager it, and you lose 20% of it. Well, that's $2,400. It works the same the other way. If you were to lose first, if you had $10,000 and you lost 20%, you'd have what?
$8,000.
$8,000. You take your $8,000 and you play it for a 20% gain. You make
$1,600.
16, and so you'll end up in the same place. You'll end up with $9,600 or a 4% loss. So not good. You lose 20, you make 20, you end up behind the curve, and that's not even counting commissions. Okay, what about the covered caller? Is he going to do better? I mean, he took a premium on the way up, and he took a premium on the way down.
Yeah, but he capped his gain on the way up, so he only made 5%. And on the way down, he didn't have a proper hedge in place. Notice how I said proper. So he still lost 15%.
That's right. That's right. Okay. I've got to point something out here, Mike. The reason I did an expose on this a little while ago. Okay. The reason that it's so easy to get qualified to do covered calls. Get this, you might be sitting at the table with somebody else that also has a bullish expectation, but they're the call buyer. Okay, if your stock goes up 20%, you sell a call, you get out, you make 5%, but the person that put up that just bought the call from you, does he do better?
Yeah, he's gonna what? He's going to make more of that 20% on the way up, but only lose a smaller amount on the way down, right?
Yeah, I'm going to say that if there are bullish expectations for a stock, and you know, the folks that are selling covered calls are the guys that are actually agreeing to take less on the way up, and suffering the consequences on the way down. So anyway, this net loss is exacerbated. It's bigger than 4%. It's like magnified. Why? Because we cut a winner short, not a loser's run. Not cool. Okay, so the married put makes only 12% on the way up, and then it loses 6% on the way down. When we do the math, we've made a net gain. That's kind of interesting. You know, we're right only half of the time, but we made money, and the reason that we made money is because of structuring these trades correctly. If you know, if we are trading the same stock in all three cases, one of them was hedged correctly, one of them had no hedge, one of them had an incorrect hedge, right, and one of them was hedged correctly. And look, now we've made made money over the two trades. So it's kind of interesting. It's the same market, okay? It's different end results, all right? If we cut our losers short and let our winners run, why then we're able to succeed long term. Here's a real life example. I talked about Altera already, right? The first time I made 12%, the stock went up 17.3. The second time I lost 5.6%. All right. Although the stock went down by 21.8% before I made the decision. In fact, it went down even further after that. Okay. Here's the stock chart. All right. Stock goes up 17.3%, but Kurt only makes 12. Okay. Now at this point I say, hey, I made money on Altera before. Let me do it again. And I was wrong. And Altera goes down by 21.8% before I got out. Curiously enough, if I'd held on to here, to where it was at 31% loss, even if I held on to there, it would have been the same. Because of my put option and where it was placed, I would have had the same loss, just 5.6%. In fact, Mike, I could be holding it today, because we buy these puts out 5-6 months out in time, right?
That's right.
Okay, so the radioactive profit machine here could have only lost me 5.6% at any point. Okay.
Now, on that quick note, well, okay, go ahead and finish with this, but we've got a question come in that you might want to address now that we're looking at the up and down of this. But
yeah, I'll go ahead and address that question right after finishing this point here.
Good.
If you make 17.3% on your way up and then you lose 21.8% or more on your way down, that's not good. Right? But if you make 12% and lose 5.6, that's much better. And that's in fact what happened. Now these two plays, how often was I right?
You're right half the time. 50% of the time you were right.
Now, when I was right, I was right. But when I was wrong, I was even more wrong.
Correct.
but still made money. Okay, and that's the idea. Okay, so it's a net gain for the Mary Put play, and it was the same stock. So Mike, all this emphasis on stock picking, does that hold up? I mean, is it necessary to just be a great stock picker?
If you're trading properly, if you're allowing your winners to run and properly cutting your losers short, then no. It's not as important as it is with some strategies that we know of, some option strategies where if you look at the math of it, you need to be right about 80% of the time to make money. Then it's really important to pick the same stock. But if you're trading properly, it's not as important.
Right. What about timing? I mean, it's the same dates. Comparing the Mary Put plays with, stock plays. I was using an entry and exit that I thought was appropriate. Okay. But it turned out to work once, and it turned out to not work the other time. All right, trading system. Do you think you need a better trading system? So many times these three deals here are what's emphasized. What's emphasized is either, hey, follow my picks, right? Or it's, oh, you need this timing system, or hey, you need to be able to read a chart. Well, okay. But I'm going to say that those things are less important than this. What's more important is to be able to manage your losses on the way down. Okay, because you will get wrong sometimes. Okay, yes. Mike, let me go ahead and take that question that came through.
Okay, this was from me, not me, but our attendee registered under the name me.
Okay. Hello,
you're married. The question is, your married put looks good in bullish market. In bearish market, we'll say from losing big, but it doesn't work in a bearish market. How do you make money in a bearish market with this technique?
Great question. There are three different ways to turn this radioactive profit machine upside down. Now, the most obvious is not the way to do it. The most obvious is, hey, let's short stock and buy a long call, right?
A married call position.
A married call position, and that is an actual term. It is an actual term. And so could you do that? Yeah, you could do a married call position. But because of margin requirements and also because of the fact that in a very bearish market sometimes they shut down your ability to short certain stocks. I think it's lunacy. I think it's stupid. But in 2008, for example, I wanted to short, I think it was OPX or something like that. I wanted to short something, and they wouldn't allow me to.
Yeah.
They said, no, you can't. What? You know, I'm going to make a statement here that is going to seem a little counterintuitive and might meet with a little bit of resistance. But Mike, listen to this statement, okay? Shorting stock provides price support.
Mm-hmm.
Does that sound right?
It sounds right to me, yes. And I think some of our investors online would agree with us. I see some of the names online, and I know we've had this discussion as well.
Right. Most folks think that it's un-American. You know, don't short stock. You know, you shouldn't be selling America short. You know, or whatever. You know, short selling stock actually provides support to the price. And they were, and it's lunacy. They were making us not short stock. They're making it so that we couldn't. I'm getting a little off the subject, okay? But the point is that you know, when you short stock, what happens is you have to buy at one point or another in order to make money, right?
Or to risk losing too much.
Or to risk losing too much. Either way, it adds buying pressure to the stock when a lot of it is shorted. Okay, now the question was, how do you make money in the bear market? Well, I've said that the married call position is the first of three ways, and it's the most obvious, but it's not what I recommend. For what I do recommend, get the book.
Right.
How about that? Is that okay?
Yeah, there are two other ways that we discussed in the blueprint, and that's how I answered it manually to me, but I also wanted to get the verbal on it as well. Now, that's if you think you're in a pronounced bearish market and you want to apply these limited risk techniques for a long term. What happens if I'm already in an RPM and the stock falls? Well, of the 10 different income methods, there are, in my opinion, 3 ways. 3 of the 10 income methods can be used to adjust the position in a down market.
Mike, can we talk about your Office Max? Was it Office Max? It was Office Max, right?
Yes, it was.
So, Mike bought in 2008 and saw Office Max go down by how much, 75%?
Yeah, I bought in at 20 and bought the 22.5 put, and over the next few months the stock proceeded to go down to about $5 per share.
Right. So by using combinations of income methods in the blueprint, what was your loss when you finally liquidated that, and when did you liquidate it?
I closed it, I think, in December. No, it wasn't December. I opened it in April, and I think I closed it around August or September when the stock was trading at around $5.80.
2008 or 2009? 2008.
I was only
2008.
I was only in it for about 5 or 6 months. I did not close it for a loss. I actually had a gain of 1.8%. Now, is 1.8% really matching my goals for a 5-month trade? No, I'll be honest with you. But it beats the pants of the 75% loss I would have had I just bought the stock. It beats the pants of about the 30% loss I would have had if actually, it was more like 40% loss I would have had if I had been trading covered calls against the position as well.
Oh, boy. Yeah, so you end up with a small gain instead of a loss in one of the worst markets we've had. That's pretty cool.
I was long stock the whole time as well. I didn't change out of it. I was long stock the entire time. The stock I was holding was down 75%, and I was able to close it for a 1.8% gain.
Isn't that something? See, that's the power of the income methods and some good trading savvy. Mike, you're my hero. That's pretty cool. Okay, so I'm going to ask, you know, we already asked, what does this mean to you? Okay,
right.
And I guess I better just show that again. Okay, so 91% of the audience would have done better. 9% say, well, you know, I kept my losses down to 6%, but I didn't win overall. Okay, we're going to share something else. I'm going to ask about spread trades. If every spread trade that you did was heads I win, tails I win more, would you think that that was pretty cool? Heads I win, tails I win more, would you think that that was pretty cool? All right. we're getting ready to show some income methods, and you know, of course, I shouldn't even leave this poll up for very long because you know it's an obvious choice. Okay, so let me just go ahead and share what's said that voted so far.
Okay.
Show me that. Sign me up for that program. That's what I want to know. All right, so I'm going to go ahead and show an example of that. Now here's the deal. You start out with your married put. That is the beginning position for every radioactive profit machine is unlimited upside and yet a capped loss. Okay. Now the conventional wisdom is, okay, the stock has to get to here before you have break even, but because it's 6 months away in time, we found that in the money puts behave a lot more differently than you would think. And in fact, with my example with Altera, for example, the stock had been at 27.35 and the put was 350. So everybody thought, okay, 30.85 is your break even. But by the time it was at 29.40, I had locked in contractually, locked in at the very worst case scenario, I'm going to make 75 cents. You know, so that kind of does away with that idea. And it's because of the income methods. You see, what happens is we alter the break-even by doing the income methods.
By either generating premium or readjusting the position, readjusting our cost basis. That's
right. And now for this, what I do is I'm going to get out of what I showed on Tuesday, okay, and we're going to show a different riskless spread trade, okay. So this is actually an excerpt from the Fusion lesson plan, okay. Fusion is the Blueprint Owners Only membership, and what we do with Fusion is we reiterate and give current examples of the principles that are in the blueprint, okay, and we'll also give assignments and so forth. There's accountability. It's kind of a coaching program. It's really cool, okay. But I'm just going to let everybody sit in on a lesson here, okay. So we've got Humana shares at 63.90. This is March, by the way, and an August 2011 $65 put option for 580. Okay, so we have a total invested of 69.70. The put, if you remember, is a $65 put. So that leaves $4.70 difference, again keeping our risk down into single digits, about 6.7%. Now, like all radioactive trades, this setup is scalable. If you have enough to trade 100 shares, why then your risk is 6.7%. If you have enough to trade 200 shares, why then your risk is 6.7%. You just buy 200 shares and 2 puts, okay? Whatever it is, it could be 1,000 shares, right, Mike? If you did that, how many puts would you buy?
Well, if I'm looking for the risk there, 6.7%, and I had 470 at risk, you know, we buy 200 shares and 2 puts. That puts us at 940 at risk. Is that right?
Yes, and if we bought 1,000 shares, we'd just buy 10 puts.
That's exactly right, yes.
Okay, either way we go, it's still going to be 6.7% risk, so it's scalable. Whatever your means are, you're able to keep your risk down to a very small amount. So yeah, 200 shares with 2 puts would be, like you just said, Mike, 940.
Yeah.
So we've got 940 at risk, which represents 6.7% of the total invested. But our upside is infinite. Our upside is not capped. This is the familiar hockey stick graph. Okay, so we're going to step away from that. Okay, there's our graph for the married put risking 940. And we're going to step away from that. We're going to do something else. Now, if I sell to open, remember this is March, okay, and my put option is open until August, but this is March. And I'm going to sell to open the April $67.50 call for 95 cents and buy to open the April $70 call for 45 cents. What do you call that play right there?
Wow, this looks familiar. Instead of selling the example 50 call and buying the 55, we're selling a 67.5 and buying a 70. This looks like that bear call credit spread that we evaluated a little bit earlier, discussed briefly a little bit earlier.
That's right. And I'm getting a total credit of 50 cents. Now, with the background of the radioactive profit machine, I can do this twice. Okay, I can do two
Two
spreads.
contracts, yeah.
Yeah, so two contracts or two spreads. Let's look at that graph. Okay, what we've got after plugging that in twice. Okay, 6750 calls short, and the 70 calls long. All right, 95 cents on the bid and 45 cents on the ask. Okay,
Got
we're
it.
taking in 50 cents two times. So how much does it cost? It didn't cost anything. We get paid $100 to do this. Yay! All right, but there's a dark side to the bear call spread, and what's going on there?
Well, we are taking in $100. We're generating a premium to do this, but we're risking the difference in the strike prices. We're risking $250, which with two calls, two spreads, I'm sorry, that would be $500 total. We keep the $100 regardless, so we're risking $400. We have a 4-to-1 risk-reward ratio here.
Right. Yes, we've got a problem. The problem is that there's $500 worth of spread here. There's $2.50.
Mm-hmm.
It's two contracts. There's $500 I'm liable for. I'm picking up $100. So what this could end up costing me is it could end up costing me $400. There's my maximum risk right there. $400 maximum risk. My maximum profit for doing this spread is $100.
Right.
Okay, so I've got the potential of making a 25% return, right? But I've also got the potential of losing 100% of my money.
Yeah.
All right, so that is the bear call spread by its lonesome. Okay?
Mm-hmm.
So what happens if we combine them? If we put them together, a far-term married put play with a near-term bear call spread play. Well, the radioactive profit machine, the married put play, has 940 at risk, right?
Yes.
And the bear call spread has $400 at risk. We just looked at that.
Yep.
So what's the net? What's the net? What would you say?
Well, if we just looked at that, we'd say, well, now we have $1,340 at risk, $940 on one and $400 on the other, so don't have $1,340 of total risk.
Right. That's what that's what we would normally assume. But the fact is that taking in this $100 removes $100 risk from this position.
Mm-hmm.
You know, taking in the $100 from the bear call spread removes $100 worth of risk from this position. And the fact that I own stock removes all the risk from this position.
Yeah.
Because after all, the only part of the bear call spread that poses any risk at all is the fact that you've got to go out into the open market and buy stock at whatever price it's trading and deliver it at the lower price. You know, if you had a naked call, okay. If it's a bear call spread, you get to buy at the upper strike, right?
Yes, I have a guaranteed contract to buy shares of stock at that price. Yes.
Right. Okay. But the fact that you have the stock on hand removes all of that risk. You have the stock on hand.
Mm-hmm.
So check this out. We start with 940 at risk in this play and 400 risk in this play, and we end up with 840 risk. In the graph on the following page, the two positions will be combined. Okay. Now, if the bear call spread costs me the maximum $400, the stock has to go up enough to cancel that loss. Take a look at this, Mike. What is the? This is all four legs now. It used to be 940. Now, what's our number here?
Well, it's only 840, isn't it, Kurt?
Right. And with the thing that we really liked about the married put play is that it had an unlimited upside, right? It has an infinite theoretical upside, yes?
Oh, yeah. We started with that 6.5%, 6.7% at risk and had the unlimited upside. Now, what have we done here?
Well, we've kept it.
Mm-hmm.
We've kept the unlimited upside because we didn't sell a covered call. We sold a bear call spread. Now, here between $67.50 and $70, $70 is the worst outcome for that bear call spread, right?
Yes, that's
$70 or higher. Okay, so at $70 or higher, well, here's the deal. We received a credit for doing it. If the stock goes up to 70, well, guess what? The stock went up to 70. We own the stock. That's okay. I'd be willing to pay the $400 that it's going to take for me to keep a stock that's gone up $10.
Mm-hmm.
Ha And if the stock goes up by more than that, and it did, by the way, it did. You see the current stock price right here was above 70.
Mm-hmm.
Okay. If the stock goes up more than 70, well, you're back in the profitable zone. Okay, so so that was a riskless bear call spread. It did not add any risk to the position. Is that kind of cool?
Absolutely.
It introduces no risk, though it takes credit. Okay, and the only way that it would take a loss is if the stock wins bigger. Now let's think about the skewed time there. That particular one did not expire worthless. Okay, but if it had expired worthless, Mike, I would have been able to keep that 50 cents credit, right?
Yeah, the $100 for the 2 contracts at 50 cents, yes.
Right, and would I be able to do it again?
Yes. So let's say this expired at expiration. The stock was trading below 67.5. Those 2 calls expired. You could sell a spread for the next month or do a different income method potentially based on your expectations and what matched your goals.
Right. Now here's how to check this, okay, because not every setup that combines a married put and a bear call spread is going to work out like I showed you. Not every one, okay. But if you're using power options, you would use the custom spread tool in the trading platform and enter all 4 legs: the price for the stock, the price of the puts, the long and the short calls, and you look at the graph for the dip caused by the spread. It should be above the break-even line.
Right.
So here I am adding all this stuff together. Okay, we've got April calls for the bear call spread, and we've got August put for the married put. And here again, we've taken our married put that had a 940 risk, now I'm down to an 840 risk. Still an unlimited upside. We've taken it from 6.7 risk to 6.1 risk, and if the bear call spread goes against us, well, we made money. If the bear call spread goes against you, you make money. Isn't that something?
Yeah.
If it doesn't go against you, then you keep the $100 credit. You can do it again and again. So kind of exciting. Kind of exciting. Okay, so let me send something to everybody here real quick. We're going to talk about free stuff, okay?
All right.
Yeah. Just before we do that, I want to ask what kind of difference this presentation has made for you. First of all, are you figuring out that this position sizing thing is important? For example, forcing yourself not to risk too much. You know, if you force yourself not to risk too much, 9 out of 10 of our viewers said that their trading last year would have been better. Okay, so are we getting that? What about this? Are you convinced that in the future you shouldn't risk more than single-digit percents? Do you like the idea of bulletproofing? Bulletproofing, I didn't actually show a completely bulletproof trade, although Humana is in bulletproof status now, and Altera was in bulletproof status before I went through the earnings announcement. Okay, but do you like the idea of being able to sit on a trade that cannot lose, and yet may still make you more? For example, Deckers Corporation. I've got what is it, 200 shares of Deckers. It's bulletproofed. Earnings happens today after the bell. If I'm wrong and Deckers goes down, I lose nothing. In fact, I'm actually going to make a small profit.
0.4%.
Yeah, I'm going to make 0.4% for the period of time. You know what? It beats a CD. It beats a CD. I'm going to make 0.4%, and I've been holding it for what, 3 months or something or less.
Less,
but,
yeah.
Yeah, but if I'm right, and Deckers goes up or even trades sideways, I'm going to make a pile of money. So that's kind of cool. Okay. Oh, would you like? I actually didn't tease you with this yet. I've got a different risk-free credit spread to show you. A different risk-free credit spread. This one normally would involve infinite risk. But in my case, in the case of the custom spread I'm going to show you, it's risk less. Okay? And, all right, Mike, I've left that poll up there for way too long. Let me go ahead and
all
share
right.
those results. All right, 69% love the idea of bulletproofing, and second place is credit spread video. So I'm going to show you how to get that.
Okay.
Yay. All right, oop, let me hide the results. Okay. Let me do... oh, you know what? We never did do this poll. This whole thing isn't about polls, but you know what? We never did this poll, so I want to ask my covered call sellers, okay? Now, only if you've done it for, at least, a couple of years, or does it say a couple of years? Does it say 12 months?
12 months.
What does it say? 12 months? Okay. All right. Do you make a consistent 3 to 6% every month, regardless of market direction? Mr. Joe Hooper came out here recently, October 4th, this year, October 4th, a couple of weeks ago, saying that people that apply his method, it says it's guaranteed effective in this press release. He said 3 to 6% regardless of market direction. And I'm just curious if anybody's actually experiencing that. If anybody's actually experiencing every month making 3 to 6%. What that means, Mike, is that they started with, whatever they started with, and then 40% year over year for 3%. Okay, 40% gain in the entire net. If you could liquidate it right now, it would be 40% above what it was last year. If you only made 3%, and if you made 6%, it'd be 100% year over year. So I want to see if anybody's actually having that. Now, before I clarified that, a couple of folks did answer that first category, but now that I've clarified it, nobody's adding to that. Because 3% per month is 40% a year gains, right? 6% per month is 100% per year gain, year over year. Okay. All right, so let me go ahead and share the result. Less than 1 out of 10 are saying yes.
Okay.
Okay, 50% are saying, wow, sometimes I make 3 to 6%, but it's nowhere near consistent. Well, how can that be? Because it's guaranteed effective, Mr. Hooper's words, and 3 to 6% consistently, regardless of market direction. I'm just quoting. I'm not making this stuff up. Okay, all right, and some folks have their account down, so maybe it's time to rethink what we're doing here. All right, finally, what do you think you should do next? I'm going to make available the information to order the blueprint, which will teach 10 different income methods, including the riskless spread trades. If you want more free stuff, let me know, or both of the above, let me know. Wow. I'm going to close it right there. 75% want both of the above. And 25% want more free stuff.
Why not?
Yeah, why not? Okay, let's go to RadioActiveTrading.com. Over here on the products page, okay, if you pick up the blueprint, it's going to cost you $350, okay, if you're in the United States or Canada. If you're in another country, it'll cost you $370, and here's why. It's $339 for the book itself, $11 shipping in North America, $41 shipping elsewhere, okay, just flat rate. And it comes with a 100% money-back guarantee, so what do you risk? Well,
nothing.
Yeah, it's almost like we talked about bulletproof trading. Why not start out of the gate with that? Okay, this is bulletproof to you, isn't it? It's bulletproof to our buyers. Okay, so you'd click here and buy it now. Now, guess what? I have some special information for folks that would like to get a special discount. Special discount. Let me see if I've got the information down here. Do I?
I think here it is.
Yeah. Okay. All right. What you get, what it'll cost, and what you risk. Okay, here's what to do right now. Go to RadioActiveTrading.com, pick up the blueprint. What you risk is nothing because the guarantee is, it makes it a bulletproof trade. You have a 100% money-back guarantee. So I don't know why anybody would not take advantage of that. It's kind of like, it's kind of like a bulletproof trade. You can't possibly lose anything, but the upside is unlimited. Okay. I don't know if this does have what I wanted to show.
I thought it did. After you get through this,
yeah,
maybe not.
Yeah, you know what? Let me go ahead and just state what the bonuses are and
Hold on one
what
second.
you can do to get some free stuff. Okay.
Go ahead. Yeah.
All right. I'm going to send out a link to everybody on the chat. Okay, and it says Kurt. That's my name. at RadioActiveTrading.com. And for free stuff, here's what you do. Put free in the subject line and give me your biggest aha moment. All right, give me your biggest aha moment. Whoops, it says Kurt at RadioActive Trading. We better clarify that's
at RadioActiveTrading.com.
Yay, there we go. Kurt at RadioActiveTrading.com. Put free in the subject line. Give me your biggest aha moment. What I'll send you immediately is the link to another risk-free credit spread video. It's 10 minutes in length. It's very intriguing. And it shows how to take a ratio call spread that normally would have unlimited upside risk and make it into something that has zero risk. It pays you to open it, and it may pay you again when you close it. This trade can be done in an IRA. This trade can be done in a limited or restricted trading account. If you're allowed to do covered calls, and you're also allowed to buy long calls and or puts, okay, you can do this trade. And you know, most brokers will never show this to you. This is revolutionary. It's groundbreaking. It's something that nobody does. Okay, all right. So that's that. If you want to get the Blueprint special offer, there's about $400 worth of bonuses that will go along with the Blueprint, so it more than pays for the Blueprint. The Blueprint itself is $350, right? $339 plus $11 shipping. Well, with $400 worth of bonuses, it's like we paid for it. Okay, Blueprint special offer. You need to write me an email with iridium. That's a radioactive element. Okay, iridium in the subject line. If you're interested to hear that offer, and we will give it to you. But it's important that you do this today. So, okay. Mike, questions? Do we have any things that I know that you've been furiously typing, but is there any questions I can answer that would be good for the whole group to hear?
Well, we had already talked about some of the income methods that can be used. The 10 different income methods, there are 3, really 2 and a combination of a couple that can be used to help lower your at risk or reposition the RPM in the case of a downturn. Emmy had written back in and wanted to know a little bit further explanation. I guess me had been looking at your track record right now in one of the positions there, and what you're going to do to repair this particular position. And I told me that we're not going to have time to discuss it during the webinar, but if you send Kurt an email specifically to Kurt at RadioActiveTrading.com with your question about the CRE position, he'll be happy to look at it for you.
Absolutely, yeah. CRE, by the way, is risking no actual money. It is a virtual trade. It's a virtual trade, and I'm actually doing it as a response to folks asking me, what do you do when something goes bad, like you hadn't set things up properly in the first place and it goes real bad.
Right.
But yeah, I'd be real pleased to answer that.
Oh, and Michael had wrote back in, excuse me, and said that he missed part of the presentation. He got called away. Well, I did record this presentation, and we are going to archive it, Kurt, if that's okay with you. But I'm only going to leave it up for a few days. So we'll archive it there. We'll have it available in the archives. You go to RadioActiveTrading.com, and you go into the free webinars and podcast tab. This will be up later this afternoon, maybe around 4 p.m., 5 p.m. Eastern Time. And yes, you'll be able to check it out. We're probably going to leave it up, I should say, for about a week or so.
Okay. Yeah, very good. All right. Well, super. Again, today, what did we do? Did I fulfill the promises, Mike? I said, first of all, we're going to solve the biggest problem that most people face in their trading, right?
That's right.
Which is controlling losses. And then, of course, the second promise was I was going to show a risk-free credit spread. Did I do that?
Yes, we did. Income method number 6, the bear call spread in the context of an RPM.
Yeah. And I also said I was going to show how to take credit, take premium in, but still leave an upside completely open. And did we do that?
Yes, we did. It doesn't cap the risk as a covered call void or an income method number 1.
Yay! Okay, so we've we've delivered on our promise, and I've also promised to anybody that sends it to me. Okay, if you check the chat box here, an email at kurt@radioactivetrading.com, free in the subject line, and in the context of your email, give me your biggest aha from today's presentation. And for those of you that are really excited about picking up the blueprint, would like to know more about the special offer, that, it's Iridium. It's their Iridium offer. Go ahead and write Iridium in the subject line of an email, and I will contact you.
Okay.
Or have somebody do it for me. Okay? Very good. Mike, you're the best. I'm so glad to work with you, and it looks like I may be visiting you here in late November.
Yeah, and I'll be seeing you tomorrow as well. Online, of course, and
the Fusion members only.
Yeah,
Podcast,
special
right?
webinar tomorrow. You're going to see an advertisement or a discussion about that soon, I should say, to all of our attendees here, of course. But Fusion members, we're hosting a special webinar tomorrow. So if you're a Fusion member, you'll be able to take part of that tomorrow afternoon about 4 p.m. Eastern Time after the market close. I did set it at 4:05, Kurt, rather than 4:15, and as I was suggesting. Unfortunately, I see some names here. I have to say this, Kurt, because this was sort of a late decision to schedule the webinar at this time. We won't be having our open discussion presentation tomorrow that is usually held at 4:30 p.m. Eastern Time for Power Options. So.
Right, that's right. That's something that Power Options does, right?
Well, I do, Power Options, I do. So that
you are Power Options, at least as far as the public face of it, right? So
that's right.
Very good. All right, Mike, you're the best. I will see you tomorrow then, and everybody, if I don't hear from you before then, happy trading.
Yeah.
And
send us your email with any questions, and email in free with the biggest aha moment, and then email in with Iridium to see that special offer with the discounts on the blueprint.
Very good.